Understanding how to read candlestick properly is critical because regardless of which trading strategy you use, you will be using candlestick. Unless of course you are trading based on Renko bar charts or something like the line chart. But most traders use candlestick charts and most strategies are based on candlestick charts, which is why you absolutely must understand Japanese candlesticks. In this video, you will learn the high probability candlestick patterns and what they indicate when you see them. But more importantly, you will learn the underlying psychology behind the formation of these patterns. There are many videos on candlestick patterns out there, but not many videos cover the underlying psychology. They tell you what it looks like and how to use it, but not why it works. Well, that's what makes this video different. So make sure to stick around till the end. Sounds good? Please hit that thumbs up button and subscribe to the channel if you are new. To encourage you to pay close attention and stick around, we also do a giveaway worth $37 for our plug and play trading package. If you wish to participate, then look for an emoji somewhere in this video. You can also find the full instructions in a pinned comment down below as well. So let's jump into the first pattern, which I talk a lot about on this channel. The Engulfing candlestick pattern. This candlestick pattern consists of two candles. The first candle being the smaller body and the second candle being the larger one that engulfs the first. Now, as the name suggests, an engulfing pattern means that the second candle engulfs the first candle. This pattern tells us who is in control of the market. A bullish engulfing bar signifies that the buyers are in control of the market. And of course, a bearish engulfing bar signifies that the sellers are in control of the market. The underlying psychology is easy to understand for this one. Suppose two boxers get into a boxing match. How do you tell who is a better boxer? Do you do that when the match is still in progress? Or when the boxer A knocks boxer out with a KO? Well, it should be obvious. In the case of an engulfing pattern, it is like the bulls and bears are getting into a boxing match, and an engulfing pattern shows who the winner is. Now, when an engulfing pattern occurs at the end of an uptrend, it indicates that the buyers are being overwhelmed by the sellers, and that indicates a potential trend reversal. When a bullish engulfing pattern forms in the context of an uptrend, it should be viewed as a continuation signal that the price is still bullish. Now, of course, the opposite is also true for an engulfing pattern that occurs at the end of a downtrend. It indicates that the sellers are being overwhelmed by the buyers and hence a potential trend reversal. If you were to see a bearish engulfing pattern forming in a downtrend, that's a continuation signal that the price is still bullish. Now, a word of caution, you should never attempt to trade just solely based on this price action candlestick pattern alone or any other price action candlestick pattern which you will learn next. You will need to combine these with other factors such as the market trend and key support and resistance level. In this video, my goal is to help you build a solid foundation on how to read price charts accurately first. So let's move on to the second pattern, which is the Doji candlestick pattern. A Doji candlestick looks like this, with the opening and closing prices being very close to each other. So what you get is a candlestick with a very small body. This candlestick pattern tells us that there is indecision between the buyers and sellers. Hence, neither the bulls nor bears are in control of the market. The underlying psychology behind this candlestick pattern is that both sides tried to gain control, but both sides' pressure were equally strong, resulting in price closing near the open. back to our boxing match example, it's like two boxers who refuse to quit and are still going at it without a clear winner. Now, because the doji could be interpreted differently depending on the context, it is important that you pay close attention, especially if you are new to trading. A doji could be interpreted as both a reversal or continuation pattern. The trick to discerning between the two is to look at the subsequent price action after the doji is formed. Remember that a doji represents indecision, so obviously you are not going to know which side is stronger if there is indecision. Thus, please remember that you have to watch the subsequent price action, unlike the engulfing candlestick pattern, which tells you which side is stronger right away. Let me show you some examples to illustrate this. So right here, the market was trending up, so clearly bulls were in control. And then we get a doji candlestick that signifies that the sellers were absorbing the buying pressure. Thus, the candle closes near the opening price at the center of the entire candle range. Observe the next candle and we see a nice bearish engulfing candle. That's the clue that a trend reversal might be underway. Now, returning to the boxing match example, it's like boxer A has finally managed to knock out boxer B after many rounds of going at it without a clear winner. Again, I will stress that a doji pattern could be interpreted in two ways, so it is vital that you pay attention to the subsequent price action after the doji is formed. Now, moving on to the next pattern, the morning star. And before you get all worried that this is some complex concept, don't worry, because it's just a combination of the first and second price action candlestick that I just went through. So let me break it down for you and show it to you. This is how the morning star pattern looks like. It is a bullish reversal pattern, meaning that price must decline, find support and start bouncing up. The morning star is a 3-bar candlestick pattern, unlike the doji candle, which is 1, or the engulfing pattern, which is 2. Remember, it's just a combination of a doji and an engulfing candle. So 2 plus 1 equals 3. Simple maths. The first candlestick will be bearish, indicating that the sellers are in charge. The second candlestick is small, could be a doji or a candle with a small body. This shows that the sellers are in control, though they cannot push the price down lower. This candlestick can be bullish or bearish and it doesn't matter. Now, the third candle is a bullish candlestick that closes above the midpoint of the first candle. When you see this, it means that the buyers have just taken over control from the sellers. From a psychological standpoint, the second candlestick represents a tough fight between the bulls and the bears. Thus, you get the small candle range. With the emergence of the third candle that closes past the first candle's midpoint, it tells us that the bulls have won the fight. So when you see this pattern occurring at the bottom of a downtrend and at an important key support level, it signifies a potential trend reversal. Now, the morning star pattern is a bullish reversal pattern. Think of it as the sun rising, so it's rising. The opposite of a morning star pattern is an evening star pattern. Think of it as the sun setting, so it's falling. And because it's the exact opposite of a morning star pattern, I won't spend so much time on it. Here's what it looks like. We have the first candle as a bullish candle and the second as a small body candlestick pattern, which could be bullish or bearish. And lastly, the third candlestick, which is a large bearish candlestick, which shows that the bears have won the battle. The underlying psychology is the same as well, so I won't go through it. But let me show you another example of the evening star. Right here, the market is in a bullish trend and trending upwards. Then we see an evening star pattern right here. The first candle here seems to show that the bullish trend is still strong, except that we get a small candle indicating that the sellers are absorbing the buyers and there is a stalemate. And finally, the third candlestick indicates that the sellers are back in control and signify a potential move down. Moving on to the next candlestick pattern, which is my personal favorite, the hammer pattern. A hammer pattern looks like a hammer and hence its name. It is created when the open, high and close are relatively close to each other. You will also see a long lower wick which indicate a rejection of a key level. Often, you will find a strong key level at the bottom of the wick which explains why price rejects the level strongly. Now, the underlying psychology for the hammer is that the sellers were in control at a point in time, pushing the price down lower. But at the lowest point, the buyers came back to defend the level. Back to our boxing example, you can view it as boxer A falling to the ground and almost being knocked out. But he gets back up and eventually knocks out the other boxer B. Kind of like a great comeback. The hammer is a reversal candlestick pattern, and when you see it at the bottom of a downtrend, it signifies that the price may potentially start rebounding higher. Now, the opposite of a hammer is a shooting star, and it's the exact opposite. It is formed when it open, low and close are roughly the same price, and you will see a long upper wick signifying that price rejects a key resistance level above. Now, the underlying psychology is the same as well, so I won't touch on it. But right here is an example of how a shooting star looks like. You can see that there's a shooting star because there's an important key resistance level above, and sellers were interested in selling there. Moving on to the last high probability candlestick pattern, this one is my favorite as well because it can be used as a trend continuation pattern. And everyone knows that trading with the trend is the easiest way to make money. This candlestick pattern is the inside bar, and as the name suggests, the bar must be inside. So logically, it has to be inside something, isn't it? This is why it is a 2-bar candlestick pattern, and the second bar has to be inside the first bar. Now, traditionally, many people view this as price consolidating and look to trade it when price breaks out either way. But in my experience, using an inside bar to trade against the trend isn't the best way to do it. I prefer to use the inside bar to trade with the trend. So if the price is bullish and I see an inside bar forming, I would prefer to stick to buying the inside bar breakout. To me, it just makes more sense to trade with the trend rather than go counter trend and hope that a new trend starts. So here's another example of how an inside bar looks like in the context of a downtrend. After price breaks, you can see that it goes on to make a big move down. This is why I recommend that you trade it this way. Before I end this video, I want to remind you that candlestick patterns should not be used in isolation. Do not start looking for every single of these patterns and start trading off them. You're going to lose money if you do that. In summary, I went through engulfing patterns, doji patterns, the morning star pattern, the evening star pattern, hammer, shooting stars, and inside bars. Candlestick patterns are useful, but only when combined with market structure and support and resistance. If you need a complete trading strategy that puts everything together, I will leave a link to one of the strategy trading videos at the top right and at the end screen over here. Thanks for watching and don't forget to subscribe. I will see you in the next video.